Okay, my name is Jack Hedaya. I'm one of the founders and principals of the Hedaya Capital Group. Welcome to Global Supply Chain, Move It Fast, the second of our four-part series that we put together to address some of the major transitions, challenges, and opportunities that are going on in the consumer product space. Future webinars will deal with branding and cybersecurity. Hedaya Capital was founded in 2003 by the Hedaya family as a spot factor. Over the years, we've continued to broaden our service offering and now provide complete factoring services, including advances, credit protection and collections, asset-based lending, trade and PO financing facilities, inventory facilities for online merchants. We focus on early stage and rapidly growing companies doing between $500,000 in sales and $100 million in sales annually in the consumer product space, as well as industrial, manufacturing, commercial services. We believe in partnering with our clients and working very closely to help them meet their goals. All clients have direct access to the principals and decision makers of our firm. I want to thank our partners that have made this event possible: Confer, Mount Jack Consulting, CStone Logistics, Riverbend Consulting, and RCS Professional Services. Thank you for joining us for the second segment of our educational series. Erwin Dayang, Vice President of Business Development and Marketing at Hedaya Capital, will be moderating the panel today. So with that, I'll hand things off to Erwin.
Thank you, Jack, and thanks to everybody coming in as they keep coming in on the screen, I see. Thanks to Molly, our producer. So we have a topic today that I think right now is probably the hottest thing going on in the world of commerce. And it's interesting. I talked with the panel prior to getting this thing together, and we're saying that, as we know it, designing and sourcing products was always the big thing, and then selling the product was always the big thing. Moving it was a given, but today it's the only thing. So we're really fortunate. We put together a great panel of people in the space. I'd like to introduce them and at the same time thank you for coming on board. I'll rotate based on the way that we had it laid out. First, Jeff Clayton from Confer, and then we have CJ from Mount Jack, and then we have Owen from, hold on a second, Owen CStone, correct?
That's correct, CStone Logistics.
Yeah, I got thrown over the Mount Jack, CStone. The Confer was easy, but okay. So if you give us a little bio about each company, and then we'll swing right into action, and we'll hopefully promise what we said in our blast is that we're going to teach you how to move your merchandise faster. Go ahead.
So thanks, Erwin. Thanks for the introduction. I'm Jeff Clayton, CEO of Confer. We're a supply chain management and financial services company. We've been in business for 40 years. AKA back office, we monitor our clients' factory production milestones. We help them book the freight. We monitor the incoming containers, facilitate the warehouses receiving. On the inbound side, on the distribution side, we process all the retailers' orders, HFC, bulk, EDI. We work with factors, obviously like Hedaya for credit approval. We're electronically connected. We ensure the warehouse picks and ships on time. We bill the retailers on behalf of our customers, assign the invoices to the factors. Then in our financial services arm, we deal with the chargebacks on behalf of our clients, collections, accounts payable, accounts receivable, and then we do monthly financial reporting. So that's kind of what we're about.
Okay, great. Okay, I think CJ, you're next. Mount Jack. Oh wait, there's no audio.
Thanks, Erwin. Appreciate the introduction. I'm excited to be on with Jeff Clayton, Jack, and Molly as well. Mount Jack Consulting, we're a group. We focus on e-commerce, for the most part in logistics and supply chain. Really help our customers and our brands find the best route for their warehousing, whether it would be in-house or outsourced 3PL. We also help our customers make sure that they have the best shipping carriers with the best shipping rates. We help make sure that they also have the right costs from across the board and audit their 3PL costs, their small partial shipping costs. and we provide a platform that is interactive with our customer, that they can look at their data and really make some data-based decisions on shipping throughout their supply chain and e-commerce logistics.
Great, thank you. All right, Owen, wrap it up for us.
Sure thing. Hey, everybody. My name is Owen Kelly. I'm the managing director of CStone Logistics. We're a contract commercial logistics company that is not limited to a single company. So I've been in business for 7 years, and prior to that, I worked for steamship lines, freight forwarders, 3PLs, what have you. And one of the things that I saw as an opportunity is, I'm not married to an employer or a customer. I make deals and logistic service agreements between best-in-class companies that are more competitive in certain areas. So, I'd like to thank the Hedaya Group and Erwin for inviting me, and Molly for her for great support. Without her help, I wouldn't have been able to negotiate this medium. Thank you.
Yeah, that's for sure. I second that emotion. Okay, so we're gonna get into the questions, and we're gonna try and roll it around. The first question is to Jeff. Let's talk about delays in the factory production today, because that's where it starts before we even move it. So what's your take on that, Jeff?
Yes, it's actually the second wave of COVID seems to be affecting our clients, especially in China. China provinces and districts are actually starting to close. There's labor shortages. The supply chain of raw materials the lead times are significantly longer than they have been. Even after the initial COVID wave in China, things started to loosen up. We're starting to see that tighten up again. We're also seeing price increases, 10 to 12% across the board. I have a ceramics company. Today's Wednesday. 2 days ago, the factory self-imposed canceled a 600,000 unit order. Just said we don't have the labor to support it. So we're seeing a lot of restrictions in India. Tirupur, which is a major apparel center, which happens to be about 45 minutes from our office. Restricted capacity lockdown went into effect on Monday to restrict 50% labor capacity in factories. We're also seeing that migrant workers that went back to their villages during COVID are not returning. I mean, obviously some of them are, a lot of them aren't, but there's definitely a labor shortage. So that seems to be the key issue with production in factories right now.
All right. Okay. Now to follow up on that, this is what we discussed prior, and I love this. Why is it so hard to get containers booked, and why am I getting rolled?
So it's a great question.
All I'm hearing every day is every day they're getting rolled. So how much more are they going to get rolled on this deal?
Yeah, not to oversimplify it, but the adage of supply and demand definitely exists here. It's no longer a buyer's market. Since 2008, it has been a buyer's market. As we all know, container prices were $1,800 to $2,200 from Shanghai to Long Beach. Now we're looking at $16,000. We're looking at as much as $20,000, and I'm not exaggerating. These are real numbers. We process the container invoices every day here, and we see it. Long Beach is reporting about 30 to 35% more imports in 2021 versus prior. We're seeing, I did a little analysis on my clients, 26% more units have been imported in the first 6 months of this year versus 2019. And that removed the outliers, I removed the startups, I removed the companies that were doing PPE. I'm just talking my base clients are importing 26% more. But getting back to your question about why is it so hard to get the containers booked? The containers are taking a lot longer now to return to origin. I've got a client that has a warehouse in Chicago. Right now it's taking 73 days from Shanghai through Long Beach to Chicago in order to get that container delivered. It used to take 35 days. So why is that? Port congestion, congestion on the rail networks, shortages of trucks, the truck chassis, shortages of drivers, warehouse workers. So a container that's taking 73 days to get from Shanghai to Chicago is taking 140 to get back to origin. And that container utilization is only happening 2 times a year versus 4. So that there's a finite number of containers. But the reality of it is, if those containers are taking so long due to the port congestion and everything like that, there's a limited amount of supply. And that's why it's hard to get containers. Containers are getting rolled. Our clients are getting rolled. I would say to everybody, push your factories to make the bookings 21 to 28 days before cargo ready date. Factories like to make those bookings a lot closer to cargo ready because of knowing that they're going to make their commitment. But you've got to work very closely with your factories right now and ensure that you can get that space when you need it.
Okay, great, thanks. All right, I'm going to switch over to Owen now. Owen, could you talk a little bit about the impact of this? You talked about, we discussed the stretched supply chain capacity, where from ocean freight to drayage to warehouse to 3PL to the truck to the retailer or wherever it's going. Could you talk a little bit about that process and where it's simplified, smooth, or there's a stoppage in that supply chain?
Yeah, I think that it's related to what Jeff was sharing about the frustrations and the shortages at origin of labor, and is stretched all the way across the ocean and into our markets. We had people that were out of work that were getting extended pay for unemployment, bonus pay for unemployment, and people weren't coming into work even when things started to move again. Inventory was not getting stripped, so people were sitting on ocean containers for extended periods of time, and they couldn't get the equipment back to Asia to load. That created, so it's all interrelated. And the other thing is that the steamship lines themselves have abdicated themselves from providing chassis. So you go to a separate company, get a chassis. There's a chassis shortage, and they're charging more for whether you let a box lapse into demurrage and per diem when it's outgated. All these things are increasing the pricing structure. And the other thing is that there's not as many carriers as there once was, so they don't have to be as competitive. And since I was in the business, these guys would be cutting each other's throats to get volume, and now they don't have to do that. And I think Maersk Line is going to make $26 billion this year, if you can believe it. I mean, that's a number. So
better than making goods.
Yeah, there's the domestic trucking is stretched, import trucking is stretched, and it's a very, very difficult situation. And I would say that invest time with people that know these disparate markets and these disparate functions within the supply chain, and try to come up with something that is reasonable.
So, okay, so based on that point, I just want to ask you this. We discussed this as well. So you said at the time, seeking longer-term deals with ocean providers and forwarders. How do they honor those long-term deals? Could you really lock it in? Like, could you arbitrage rates, or how do you do that? Like, let's say today's 18,000. I mean, maybe it'll be 3,000. Could you negotiate out now? And how does that play?
Yeah, I mean, the larger volume importers are certainly getting some relief from these huge numbers, 15, 18, 20,000 to the West Coast from China.
Right.
And there are some companies out there, I know, friends of mine in the business community, people that have had long-term relations with Matson, and Matson was always, 30 or 40% higher than the regular companies, but they're honoring their rates and carrying cargo at far less than what the spot market is today.
Uh-huh.
So I think there are there are achievable negotiations and arrangements that can be met with the right service providers.
Okay. Okay, great. All right. So now we've been talking about moving the merchandise, and a lot, I think, has been in the brick and mortar sector. I want to switch to CJ, who's the e-com champion, and talk about a little bit how do companies control their rising parcel shipping and how do they keep their customer experience in line with what's going on that level, where in that whole supply chain. CJ, could you talk about that a little bit?
Yeah, absolutely. Thanks, Owen. I think similarly to what you're seeing overseas in terms of cost raises and price raises, you're seeing that same thing from FedEx and UPS and the small parcel carriers. Obviously, no one expected COVID, and wow, there was a lot more shipments going through those networks. A lot of those networks were residential networks where a lot of their commercial business kind of dried up. So their networks got overfilled and we saw costs go up. You saw both carriers implement peak surcharges on residential shipments for extended periods that lasted well outside Q4. So what we've been doing and what I talk to a lot of people about is understanding how those hit your bottom line and making sure that you're auditing those costs. Everything that you can do from a box size perspective to try to keep your boxes in line with the smallest possible to fit your product so that you're eliminating dimensional weight. Anywhere you can look at some of your surcharges and some of the things you're implementing there, and then also using the right mode of transportation for your customers, ensuring that you're not shipping higher end express shipments to locations that you might be able to reach that same location with a ground or a less expensive service. So really customers, again, like you said, Erwin, they were looking at their shipping like a line item on their balance sheet that wasn't adjustable. And when that line item got a lot bigger, they started wanting to find ways to adjust it. So realistically, understanding all of those costs and being able to understand that is huge for our customers. I think that you'll see the best in class really looking to optimize their locations as well, making sure that they have locations and warehouses that are close to their customers. And if they're able to, and when they're able to, it's scalability to split their inventory and potentially have multiple warehouses so that they're utilizing more of those ground shipping services rather than the express shipping services. We also see them in terms of offering different options to their clients. So maybe the client is willing, maybe their customers are willing to pay a little bit more for their express overnight or 2-day shipping, then they offer a slower standard shipping for free. So I think really when you see clients doing that, the best in class are also monitoring a lot on their websites in terms of abandonment rate and watching that customer experience as they walk through your site. And when they get to that shipping screen, understanding what the abandonment rate looks like and offering customers different options to see what each customer wants. So understanding and managing your shipping profile, making sure that you're looking at your invoices and auditing those to understand your true cost per order is something that is becoming a lot more important with the rising costs here across the small parcel, just like we see in trucking and overseas freight.
Right. Okay. So just to follow up on that, we discussed developing an in-house e-com fulfillment operation or outsourcing it to a 3PL that specializes in e-com, because so many of the people in the brick and mortar world either had the foresight, vision, or luck a couple of years ago to develop e-com infrastructures. But when the pandemic hit, I know tons of companies that we are involved in, or I know over the years, all of a sudden everybody wanted to go online and didn't even know what the internet was. So talk to us about that.
Yeah, I think what customers really want to do when they want to break into that e-commerce is understand, number one, the staff they have at that warehouse, whether someone's had experience with e-commerce or whether they've all been, retail and wholesale. The way I try to round it out is that wholesale retail business is really pallet in, pallet out. It still has complexities to it. There's still a lot of touching, but once you evolve into that e-commerce space, it is such a high touch unit. You have to put individual units away. You have to pick individual products or individual units for orders. You have multi-ship orders. You have single line orders. So the methodologies and the strategies used for e-commerce are often very different from those of wholesale and brick and mortar. So number one, you need to have the knowledge and someone on staff that can definitely train your team. I think number two, you have to understand the technology you have at your warehouse and what that investment would be. Every warehouse has a different WMS system and a different way to work. But again, when you bring e-commerce in aside from retail and wholesale, that e-commerce is going to need itself to have many different opportunities for picking technologies, return processing, inbound technology. So a lot of those are different. So you also have to understand your technology and ensure that that can work, or that you can build something out with the right partner in a time frame that's affordable to be able to have someone that can do that as well on your side. And I also have a lot of customers right now that either have tried it or are in the process of saying, hey, we don't want to deal with this anymore. To be honest with you, as it's hard everywhere, the labor market's difficult. It's difficult for everyone. So, you know, I do have a lot of brick and mortars that have tried it, or people that are saying, hey, I'd rather go to a shared facility with shared resources because it's really hard for me to control my overhead right now. So I think it also depends on the situation you're in from that perspective. But there are a lot of factors at play, I would say. Location, people, and technology, ensuring you have those, and then understanding costs and how that would roll out. But I definitely think for each company is different, but you have to weigh out all those factors in order to make sure you're making the right decision for how you're going to scale your business.
Okay, great input. So let me just throw this to Jeff and Owen. How's the e-com piece play out in your world? So Jeff and then Owen could go. How does it change the dynamics of what you do?
So, Owen, do you want to start or?
No, go ahead, Jeff. Go ahead. I'll wait.
So, we've seen a big uptick in e-commerce with our clients. Amazon FBA being the leader. I would have to tell you 90% of our clients are doing Amazon FBA right now. But also the Walmart.coms and the Target.coms. We're seeing a lot. We're seeing a lot of movement. Kohl's.com. Most of our clients have already been in that space prior to the pandemic, and they're capitalizing on it right now.
Great.
Yeah,
Okay.
and I would just add that the 3PLs that I'm working with are also getting more and more involved in e-com, third-party logistics services, and you know they come in all different forms. It can come right in through their website if they're vertically integrated, or it could come off the retailer's website, as it often does with Walmart.com and Target.com. You order something on the retailer's website, and then the EDI 940 goes from the importer to the 3PL, and the order is shipped. One thing I was listening very carefully to CJ when he was sharing is, the manner and the number of touches and the return processing, that dries up your percentage of distribution, of course, because it's not like just shipping in a box on a pallet. When you're dealing with ones and twos of units, you got to make sure that you're capturing that cost and the cost of goods sold. That's the only thing that I would like to add. That some people don't really understand that how much it does cost for you to distribute it yourself or for a 3PL to distribute it. It's not like moving cartons.
Okay, great, thank you. So this is the question.
Just tag on to Owen's point there, which I think was a really very good point, is you've really got, when you're working in e-com, you've really got to account for the returns. And it depends on the industry. Apparel has a huge number of returns compared to home goods products, let's just say.
Right.
Because how often you see somebody will buy a small and a medium online, knowing that one of them's going to fit, one of them's not going to fit, and there's going to be an automatic return. And the cost of the return, a lot of the retailers are either saying, we're going to charge, the return is going to go back to, let's just say, Macy's. Do you want us to charge you to return it to your distribution center, or just absorb it? And that becomes a significant factor in pricing.
Okay, so this is the question for everybody. And whoever has the right answer is going to get the grand prize. When is container pricing going to get back to normal?
Whose crystal ball do we want to look at first?
I don't know. So you guys, whoever wants to be Houdini, take the stage.
Okay, so I'll take a shot at it first, and then and Owen can follow me up. Most of the freight forwarders that I speak to are telling me first and foremost, we haven't hit the peak of pricing yet. I know personally Hapag-Lloyd, who's been on the lower end, as of this coming Sunday, is adding a value-added surcharge of $5,000 a container. I personally don't think we're going to see very much relief before Chinese New Year. Typically, peak holiday season is August to October, but again, going back to the production delays that we've seen, I think it's going to continue through the end of the year. And then at the beginning of the year, we're looking at, an increase in shipping based on trying to get everything up before Chinese New Year. So historically, March and April are slower months. We might see some relief then. I think one good piece of news, steamship lines are ordering new container ships at a record pace. In the first 5 months of this year, there's been more orders for new container ships than there were in 2019 and 20 combined. So I'm thinking 2023 is going to be more where we can hopefully be back into a buyer's market. But at this point, it's a very hard question to predict.
Right.
One quick thing I want to say based on container pricing, though, is that we do have clients. We have many clients that have successfully gone back to the retailers to participate and assist in absorbing some of these costs.
Wow, that's great.
Both mom and pops as well as major retailers. So if there's anything that can be a takeaway from this question, from my standpoint, is go back to your retailers, and everybody's realizing that this is a very, very big problem, and it's going to have to be absorbed by the factory. If it's an LDP order to a certain degree, it's going to have to be absorbed by the importer, by the retailer, and ultimately by the consumer.
Right. Right.
We've seen the same thing from a handful of our clients as well, where we've communicated with retailers, and the retailers were willing to participate with the increase to cover some part of the increase.
So it's a great segue. I wanted, after Jeff made that remark, I wanted to ask Jack, throughout this whole process, because Hedaya Capital finances this whole supply chain from wherever it's coming from to the retailer, how does this affect a client that's getting financed, Jack? If it's delayed, if the ship is en route, if it's what's the magic bullet?
So we have seen more clients utilizing LCs, which wasn't happening for a long time, but I guess people want to secure their inventory and make sure they lock up the production and get their factories to work with them on a time frame that's going to work to the best, possible, the best of their abilities. You're having some of the retailers who extended their terms early on in the pandemic are still keeping long terms, 90 days, 110 days. So that is stretching out the trade cycle also. They're turning their money slower, so the factoring is coming in is more important for them. But the government subsidies, the PPP loans and the EIDLs were a big help to a lot of the importers. I mean, it was a lifeline for across the board. The market would have been dramatically different if the government did not step in with those facilities.
Okay. All right. So the other thing that we discussed was and Jeff had brought it up, and then you could throw it around, was retailers willing to accept POE shipments these days. So maybe you could talk a little bit about that, because maybe that alleviates some of the pain.
So, Owen, I'm sure you're seeing this as well, but we're seeing a growing number of retailers, mostly in the off-price market, willing to accept and move a model more towards POE shipment, right? So they're picking it up at the port, avoiding the warehousing element. So it does a couple of things. Number one, it alleviates time, going back to the original question we were talking about with the production delays, and then the container delays and getting rolled. Product is coming in, so much later than it should be. So if we can minimize that warehousing component and save maybe 1 to 2 weeks of transit time, the wholesalers are willing to take an entire container. I've had customers that had 70% of goods in a container for one retailer and 30% stock, and the retailer is willing to actually buy the other 30% of product just to be able to have that shipment converted to POE while the container's in transit, by the way. And the wholesalers, our importers, our clients, they're willing to give a price break to the retailer because they're avoiding the warehouse costs. So we're seeing a big uptick, a big uptick in POE shipments.
Right. And just to throw it back into the financing court, Jack, how does that help the importer if they pick it up? Does that alleviate some of the financing costs, or improve their credit? Or?
It reduces the cycle. So if they're shipping it 2 weeks earlier, it's 2 weeks earlier that they'll be able to get paid from the retail, or they'll be able to factor the receivable 2 weeks earlier.
Right. Okay, good.
Yeah, I just want to also, everyone, if I might add,
jump in.
Yeah, on the POE thing, there's, the rail service for international ocean containers is very poor at this time too. There's huge backups in Chicago. If people have warehouses that are in the interior in the southeast and traditionally have come over the West Coast and gone mini land bridge or inland point intermodal, you can't get that cargo, booked as well. The steamship lines are, I think getting a little bit more educated on what their repositioning cost is. They used to just move containers all over the country and then, not properly account for what it cost them to get that container back to Asia, whether or not it was loaded with export cargo or not. So when the retailer needs goods, so if they're going to kill those import moves at a gateway, I'm even seeing some companies getting on the ship to go to different ports than they've even traditionally gone through, maybe an extra 400 or 500 miles from their warehouse, if it's not done on POE. So there's a lot of ways to get creative, and in the end, the consumer's going to have to pay for it. There really is no other way. The providers aren't going to absorb it. The retailers aren't going to, and the importers aren't going to absorb it long term either. Otherwise, we'll all go out of business.
Okay, great. Okay, so all right, so I'd like to go back to CJ and just talk about some of the things that Jeff said and Owen said, that retailers, would absorb some of the costs. It has to be sort of a collaborative effort. Listen, at the end of the day, if they want goods on their shelves, so they want to be able to ship goods to somebody's house, then everyone's going to have to chip in. Otherwise, it's not going to happen. But when it comes to e-com, because it's an individual deal, it's a different model. So Jeff, actually CJ, could you talk about, you talked about free shipping offers, how the companies, set their threshold, and then what I like, the unboxing experience, and a couple other things that are built in to sort of accelerate it and make things smoother in the delivery of goods.
Yeah, absolutely. I think that as you see brands online right now, they're really trying to compete for that customer experience. It's a differentiator. It's a very big differentiator from an Amazon experience, and making sure you're able to have the best unboxing experience and also be able to manage costs with that. And that's, a lot of times you get marketing and operations together, and making sure that your marketing team and your operations team are walking hand in hand to understand the decisions that are made from what box you're going to buy and what it's going to look like and how it's going to affect the shipping cost and the customer experience is important. Starting off with something like free shipping, customers often ask me that, and until they really drill into their shipping costs, it's difficult. Most customers base their free shipping off of a dollar number, over $100, over $120, over $150, you get free shipping. I think the key that what a lot of people miss is they may take the actual weight of their products in and try to do some calculations to see what they may or may not be charged based on actual weight. But a lot of customers that I see, they're missing the dimensional weight of their products. And for those of you in the small parcel world, FedEx, UPS, they will take a dimensional weight of your product and the actual weight of your product, and they will charge you whatever comes out higher. And a quick run of the dimensional weight wise, they take the length times the width times the height of your package over a denominator, and the standard denominator is 139. So if you put a cell phone case that weighs 1 pound in a 10 by 10 by 10 package, you would ultimately get charged, instead of getting charged 1 pound for that, you would get charged 12 pounds for that. So what a lot of customers miss when they're discussing free shipping or picking that threshold is what the actual shipping cost is going to be on that item. So what I try to tell my clients to do is make sure that, on your websites now, your Shopify, your Magentas, they're able to take in the dimensional weight of your product and the actual weight of your product. So you can put that in there to help make those calculations. That's number one on the front end. And then number two on the back end is just make sure you're, again, like I said, auditing those prices and those costs. One of my clients was shipping an oversized a blow-up chair, where the blow-up chair in itself only weighed 2 pounds, but part of it had to be delivered blown up. So it dimensionalized out to over 15 pounds. The problem with that is it really changed the shipping. So this chair on its own qualified for free shipping, and each time that customer sent it, they were actually losing $30 to $40, when on their financials and their spreadsheet, it looked like they were going to make $15 per shipment. And the problem is, if you're not auditing those can go for a very long time without you understanding that. So auditing the dimensional weight of your shipments is really key to understanding free shipping. And you can still offer a free shipping threshold. When I see my customers that are being as proactive as possible, they might have some products that don't qualify for that. And when you go onto the landing page of that product, it simply says does not qualify for free shipping. Consumers are getting more and more adapt to being able to see that and understanding that shipping costs even on the small parcel side is getting so high. And then finally, when we talk about that unboxing experience, you've seen a lot of customers, you've even seen companies like Tiffany's and other companies that used to have elaborate outer boxes that might have been 4 or 5 color boxes. They could have been a complete shine, gift wrapped on the outside. You're seeing them change that to more of an unboxing experience on the inside. With the places that these boxes have to go through the terminals and through the operating stations, a lot of time those glossy boxes or those extra color boxes look great when they leave your warehouse, but they arrive to the customer having them feel a whole lot different about your brand because there's markings or dirt or something along that. The second thing, and what we've seen even more importantly, is the porch piracy that's come with this age of delivering goods. If you have a hot product or a hot commodity, or you're a hot brand, and I'm walking past a stoop on 38th Street, and I just want to be able to grab that, and I see your box over a bunch of other brown ones, it's much easier for you to be able to go ahead and scoop that box, leaving the customer unhappy, and then obviously the company losing the product. So I think that understanding shipping costs and making sure that your customer experience is great is really where operations and marketing teams have to come together to calculate that on each of their products.
Right. So this is for all you guys as well. We talked about shipping and rail, and how does air freight play a role in all of this? Is that like is that an exit strategy, or is that a detour, or is that a quick fix?
The air rates forget about it.
It's out of
They're crazy. I agree with Owen, but I do have people that use it as like you said, it's a necessity. They have to. If they don't get this product in. So it's something that, yes, they don't want to use. They are through the roof, but I do have customers that to keep their business afloat, they'd rather take a hit on this shipment to keep customers happy and keep that,
Oh, you mean because of time sensitivity?
time sensitive
You
product.
get items like, let's say, a portable electronic piece that's $100. If you're air freighting it, isn't it economically better than sending it on the ship? In today's market, I'm saying. Nobody's answering.
It's a good question. Air is significantly still higher than ocean freight. I mean, it depends on the commodity, right?
Right.
I've got a costume jewelry company that airs in 85% of the merchandise because
Wow.
it's small,
Yeah, that's what I'm saying. That's crazy.
and it's it's compact. Air air charges are by weight, they're not by cube. So if you look at how much the costume jewelry weighs, some of the bigger bangle bracelets, stuff like that, they'll bring it by vessel, but it really depends on the commodity, I would say, in my opinion.
Okay. So this is my question that I always think about whenever I run a webinar. I just ask people in general. It just gets my mind going. Is there, in the world of supply chain, as we talk now, between all you guys being in it so many years and day to day, is there a disruptor? Is there an Uber in ships? Is there someone out there that's making this thing, the old model not work? Could you touch a button and get it shipped that's half empty and get it back here? Or is there such an animal like that?
I think so, but I don't. I think we're going to start to see distribution. Not that this already isn't taking place. I know that it is. I think the distribution is going to get pushed back to source origin, and having parcels move out from source origin. Because you can save on entries and duty because it's under a certain amount of money, and it can be efficient. The price of the product, the margin in the product, of course, all is contributory to whether or not it's functional or not. But I do believe we're going to see more of that in the years to come.
Okay.
Yeah, and I agree. I think even in the small parcel space, you see more regional carriers coming into play. You see people like DHL coming back into the domestic market a few years back with their DHL e-commerce product. You do see regional carriers as well. Amazon took a little bit bigger of a swing and stepped it back a little bit in terms of their delivery service. But you're still seeing a ton of Amazon trucks. I can tell you, where I live in Jersey City, I see far more Amazon trucks than I see FedEx and UPS trucks right now in terms of running around there. So you definitely see in the small parcel world that happening. That duopoly for really the heavyweight stuff is still there for the foreseeable future. They have a lot of leverage right now, but like I said, I do think you're going to see regional carriers and potentially, hopefully in the near future, regional carriers starting to come together to formulate a third and fourth and fifth option in what is right now a very small business, very small opportunity to get into because of the barriers of entry that it does have between trucks and distribution centers and everything it's needed to run that type of business.
Excellent point.
So we're running, over our general time limit, and we could talk about this topic forever, but I want to really thank you guys, and I'd like to do two things. I'd like to wrap up by asking each one on the panel to just give a takeaway to the audience out there of where we should be going, and what you think is going on. Just some tips on how to walk away, whether it's shipping, e-com, finance. So whoever wants to start, let's round out with that, and then we'll go to some Q&A if there's some questions out there.
So I would just say to my customers, really be cognizant of both your time and action calendar, making sure that you're on top of your suppliers as much as you can. They are your partners. They're willing to work with you. They're willing to work with you from a production standpoint, from a cost sharing standpoint, and also be cognizant of your costs. You know, I have many clients that are importing, you know, anywhere from 500 to 1,000 containers a year, and if a container is costing $10,000 more today than it did 18 months ago, that's
$10
$5
million.
million.
$10 million. Wow.
So it's significant money. So, you know, be very cognizant of this.
Okay. Jack, Owen, CJ, who's next?
I can jump in and backing that off of Jeff, obviously be cognizant of your cost. That's the same thing I would say on the small parcel side. Make sure you're digging into that, you're understanding. In terms of whether you're working with a warehouse that is your own warehouse or you're working with a 3PL, I think communication with that warehouse and understanding, being very laser focused on projections and making sure that you know you're trying to be as informative to those people as possible, because as we all know, the labor market right now is so difficult, and really understanding those projections, especially if you're with a 3PL, because as you come into this Q4, everybody's business tends to, like in a normal e-commerce, most of your 30 to 40% of your business can be in that Q4. And if you haven't had the talks already with your 3PL or your warehouse, or they don't know the projections, they don't know the daily order values, I would say really work on getting that as quickly as possible. Your partners and those people are only as good as the information you gave them. If you walk in on November 1st and you tell them that your forecast is going to be 5x what they planned for, labor at that time is very difficult to get. So the earlier you can work on this and the more communicative you can be as those things change, I think will really help you have a successful 2020 peak for 2021. And that includes reaching out to your small parcel shipping providers, making sure they have the space on their trucks. As many of you saw last year, there were times when FedEx and UPS and multiple companies said, we can't take your product, or they told your 3PL, we're not taking anything else, and you had those headaches. So not only please work with your warehousing partners, but please work with your shipping partners and make sure they're ready for your volume so that they can make sure you have space on their truck and their network so your customers aren't disappointed.
Great.
Jack, if you don't mind, I'll jump in. I think it's appropriate that you have the final word. Now, I concur with what Jeff and CJ have shared, and I would just say that with the challenges in the supply chain all over the world in every mode, I would suggest that the customers really take the time to vet out additional opportunities or double down on their existing relationships for a longer term bang for the buck. There is gouging going on out there, that's for sure. And, you just have to, be painstaking in the analysis. Thanks.
Great, thank you. Jack?
And I agree with, all the panelists that keeping an eye and a focus on the costs is very important, and making sure you're capturing it correctly, because it is a huge expense now, where it was in the past. And some people are taking the approach, and they're guesstimating, but I think you really gotta analyze it very carefully and understand it, and really make sure that you're covering the costs or capturing the costs properly. And the other suggestion is, communicating with the retailers ongoing to make sure that you are working together to come up with the best solution, whether it is point of entry, whether it is taking the merchandise overseas, or whatever is possible to really make the process as efficient as possible. And, communicating with your lenders as well. If they're expecting certain things and there's delays in the process, the lenders always want to be aware. You want to make sure that things are moving smoothly and efficiently at every stage of the process. And communication with all the partners is very important.
Great, thanks, Zach. Molly, any questions out there?
So whoever wants to ask a question, you could throw it in the chat box and I'll read it out to the panelists. There's one question here that says, should importers push to sell FOB China to push the freight rate uncertainty to the retailers?
Who wants to take that?
Molly, do you mind repeating that?
Yeah.
Should importers push to sell FOB China to push the freight rate uncertainty to the retailers?
We do see, the answer to that question, I would say is yes. Retailers are cognizant, obviously, of, depending on the retailer. Walmart have contracted their own carriers. They've contracted their own ships. Home Depot has also done the same thing to ensure that they can get the space and that they can reduce costs. But I also know that we have clients that their model is always been selling FOB, and they're getting a lot of pushback for rate reductions.
Wow. Interesting.
Yeah, I agree. If you can do that, great. It all depends on what you're getting paid for your goods.
Right, but then like Jeff said, that the big guys like Walmart, Home Depot, that have their own ships, then they have that strategy to move the goods. The other retailers, unless they don't, they're really waiting online for the ships as like anyone else, correct?
Yeah, it's their FOB customers and their vertical imports. They're still buying a tremendous amount of landed goods.
Right, right. Anything else, Molly, there?
Someone asked, can importers tack on ocean freight surcharges to retailers to cover out of the ordinary freight charges? Would retailers accept this easier than a price increase?
I think Jeff talked about that before, but if you want to expound on it.
Yeah, so actually, we do have a number of our clients that have, it's not a price increase, it's actually a separate line item on the invoice. They've made an agreement with retailers to say that, we sold something at a wholesale price of $10. We'll still continue to sell it at $10, but at the end of the invoice, we've increased 50 cents a piece on every unit that's been sold, and we have seen retailers accept that.
Okay, anything else, Molly, there?
Someone asked for CJ, what are your top 2 to 3 recommendations to save money on e-commerce shipping now?
Top 2 to 3. I would say number 1 is make sure, like I said, from a mode perspective, that you're using the right modes in order to deliver to your customers. Rather than just shipping something express for a one-day commute, like I said, you may be able to use ground or a lesser service. So that would be number 1. Number 2, obviously, would be it's a difficult time to negotiate rates right now. It's just you're coming into peak, and we're still having COVID-like volumes go through the residential network. So taking a look at your agreement and making sure there's no areas that you can negotiate is one area, but like I said, that would be very difficult. The other areas I would say is just making sure that you understand also the dimensional weight of your product and that box size, because that is a huge increase to people's costs right now. So, looking over the services you're using, understanding what dimensional size you're shipping, and understanding getting your customer at a day delivery, maybe not a service delivery, might be able to lower some of those rates.
Someone asked, referring to COVID-19, besides for the container price change, what else has impacted logistics?
I would say the steamship lines getting out of the chassis business, getting out of the intermodal rail business, and not really delivering value for the services they're providing.
I think that's it for now.
That's it? We're good? All right, guys, it was really great. It went longer than we expected, which I'm happy about because it was fast and furious. And I hope and I know that a lot of the input will definitely help goods move faster and cheaper. And like Jeff said, bottom line, like Jack said, watch your numbers. I think all these ingredients, put it into your your financial soup bowl, and then you come out with a a greater profit margin. So again, I want to thank everybody, Jeff, CJ, Owen, Jack, and Molly, our producer. And we look forward to our next event, which will be cybersecurity, August 25th. Another incredibly hot topic, another topic that if you asked me a year ago, I was always sourcing, design, and selling. Now it's shipping, and watch, when I wake up in the morning, will all my information disappear? So the next one will be cybersecurity with RCS and an all-star panel like we had today in logistics in the world of cybersecurity. So everybody stay safe and well. And again, thanks to the panel. It was a great experience. Have a great day, guys.
Take care. Thank you.
Have a great day.